Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, October 26, 2022. So we're nearly halfway through the big FANG earnings week. In other words, today is technically hump day as far as the week goes, but this earnings hump week, peak earnings week, won't be halfway through until after the close today. That's when Meta reports. Again, Meta's not a mover of the needle nearly as much as the two that are coming out tomorrow, Apple and Amazon, but regardless, it'll certainly has the potential to move the market somewhat and again set the tone. So we'll see. I'm going to go over in this video stocks, bonds, and gold, the usual suspects. Maybe crypto as well. Got that out to you recently, and then maybe an update on the natural gas trade, time permitting. Starting out here, I just wanted to go over the fibs real quick because we're at some key fib levels, so I wanted to get this out in the beginning of the video and show you this is an objective area to short, or if you're actively trading like I've been doing lately, especially this week, in and out, in and out, it's a good area to close longs and or reverse to short. What you're looking at here is QQQ. This is just Fibonacci retracements. This is from that peak in August, right here, mid-August. So that's how you want to use your fibs. You want to look for major reaction highs, such as this, come down to the lows, and that's what I did here. So you're right at the 38.2. The 38.2 is a key Fibonacci retracement level. Typically, counter trend rallies will often retrace anywhere from that 38.2%. There's your 50% up to the 61.8. Now, guess what? It's not just that. We've got a whole bunch of them. So I just I've been in and out several times today, but I just reversed and put on some shorts after closing out some longs, and I'll show you why. This is a 2-hour chart, but again, just focus on that mid-August high right there. What I've put up, and I could have done this on QQQ as well, but what I have are two different set of fibs. This chart's a little messy. I can turn off some of these, delete them, but what you see here is the dual, the 50 and the 38.2. So what I've done is measured both that mid-August high, and that gives us a that would be the 38.2% retracement. Then I hit this major peak right here, and that was around September 12th, give or take, and that one is at the 50%. You can't see them because they overlap. You have two lines there, so you have what they call a fib cluster there. That's also a previous reaction high with resistance right there, a previous reaction high. So there's price resistance as well. So a great time to game a pullback, in my opinion. You could trade it as you want. There's a million and one ways to trade. It's earnings week, so you're going to continue to see some volatility, and that can go in either direction. You got the Fed next week, but actively trading, traders are most likely to step in there. And then not just that, I also threw on didn't have any of this going into today, but I threw on an RTY short as well for day trade pullback here. That's right at the 50% Fibonacci retracement as well. So you have, the small caps have been outperforming recently. They've been doing pretty well, and a nice rally smack into that 50% Fibonacci retracement off the mid-August high right there. There's your date line right down there. So that's what you want to look for. And of course, price resistance helps as well. There's nothing screaming on RTY on the 60-minute chart right now. You do have a little divergence. And again, the 10-minute time frame, I'll get down to that in a second. That's my go-to swing trading time frame. You look for these divergent highs, negative divergence right there, in a rally into resistance. In this case, on RTY, it's primarily into that Fibonacci resistance, the Fib retracement level. Swing target would be, you have a trend line there, you have a minor trend line there, you have a little reaction right there, a little price support there, and you can go for any or all of those, again, depending on your trading style, whether you trail stops down, whether you just have a sold target, whether you scale in and out and you have multiple targets, multiple entry points. As they say, there's many ways to skin a cat, and there's many ways to trade a stock or a security or futures or whatever it is you're trading. Or I think the saying is there's more than one way to skin a cat, something like that. All right, let's go to let's look at QQQ. Go back to that because that's what it's all about right now. These big market moving FANG stocks are reporting. You're at the again. You can see here. Move that line up and zoom in right. See, there's your previous reaction highs right there. That's what capped us the other day. We're back to that again. Just been great day traders market, not so much swing trading, although we have lifted. We're still not too far off the that the yesterday's high, which was the high for the rally, about I think 10-11% or so, and we're still coming off that divergent low. So right now the near-term trend is certainly up. But a lot of volatility going in. Let me just give you a 60-minute chart. Show you one more thing here. Zoom in nice and tight. So remember, recently we did take out this downtrend line there. That's not what I meant to grab. We'll go with the blue line here to overlap that purple line. Took that out, but then when you zoom in, you've got a couple things going on. You had remember I pointed out yesterday, and it's almost there, but not yet. They're trying to foil this bearish PPO crossover. See that PPO line coming down? Boom, and then not rejection, but it's just flattening out. Sometimes that's what it does. Then it'll cross, and I think it'll cross here because, again, I just showed you, made the case. We're at multiple resistance levels. You have that PPO coming down to crossover. If nothing else, just a day trade fade. You have on the 60-minute chart again. You have the uptrend line right there. You had that bearish rising wedge pattern, I believe I pointed out yesterday. You gap down today. That gap down was to multiple support levels. You had this line I had right here. You gapped right down to that. And then more importantly is that my favorite, the 10-minute chart. And go down here, step it down. 10 and 5-minute chart is what I've been trading off of. So you can see here clearly on the 10-minute chart we're on right now of NQ. You had nice positive divergence at today's low. You also pulled back right to that beautiful, so far beautiful lately, 11,432 support. You can see support. We're in a little trading range there. Rallied up, put in that divergent high recently, which was a catalyst for the pullback. Objective case to short. And then we took out the minor trend line. There was a sell signal, went down, hit it again here, bounced up, hit it again here. So we've been ping-ponging. These are your levels. These are little micro levels. Even that one, if you zoom in real tight, which I'll do, we'll step it down from that's a 2-week 10-minute chart down to the 5-minute chart, and you can see all the same stuff. You see positive divergence. Look for these divergent lows. Look for that divergent high like we had there yesterday. I just showed it to you on the 10-minute chart. Look for little trend line breaks, and just ping pong. That's what these indexes are doing. They're just ping ponging. The algos as well as humans are seeing these levels, and they're buying pullbacks to support. That's a big one now. Look how many reactions we've had on 11,434. So, and you also have a very steep uptrend line. You can even step it down to a 1-minute chart, and then you'll see that steep uptrend line right there. You can see the PPO is poised to make a bearish crossover. That's also a pretty accurate trend inflector, if you will, or trend change indicator. You look for bullish crossovers on the lows, you look for bearish crossovers on the highs, and that's usually when you get pullbacks. And then again, you can step it down as short as you want. You want to go down to a 1-minute chart, trade the 1-minute chart. Traders are certainly watching these levels. You want to align it, check with QQQ as well. So you're a little bit above the trend line drawn that way. And again, you want to play around with QQQ. Look at a 1-minute chart. You can see also we're coming for a gap backfill. Traders are going to look at that gap, and if you try to get the whole gap, you're likely to miss a fill. So I like to short when I see a well-watched resistance level, like everybody's looking for a backfill the gap. My bet is they're probably going to step in a little early. And if they don't, what they usually do then is they'll pop it, clear the stops. If there's enough money right now on the big trading desks, in these algo programs, they can try to run it up, clear out the stops, and then reverse it. So, again, I have pretty high degree of confidence this is a nice area to reverse. And if you also look at how much they bought up the dip so far after last night's earnings smackdown on Alphabet and Microsoft, you can see it's been about a 2.3% reversal. That burns a lot of energy, if you will. A lot of fuel is spent to do that. What I think it was, and I suspected this morning, you have probably had a lot of shorts pile in things like SQQQ. They probably piled in last night on the earnings, and And then and it was a good time to short based on those everything I just showed you on 5 minute charts and NQ. But again, how much of that was a good drop, and that's it. This market's not going to go anywhere until the big fangs are out of the way. It's probably going to most likely to continue to grind around. It might even grind around until the Fed meeting next week. But again, so in stocks, still same story. Active trading is my preferred MO while I'm sitting strong and long on the treasuries. TLT, nice setup there yesterday as I covered there. Let me show you these two candles. Here's TLT. I'm trying to zoom in and so where you can see it in the video. My volume bars are obscuring it a little bit, but you had the two gaps down right here. Or, I'm sorry, yeah, two gaps, two candles, island cluster bottom, separated by a gap on each side. So you had the upside gap yesterday, which that was check mark number one. That gave you the island cluster bottom, and so far a green candle. And again, as I've mentioned, one of my favorite trades lately, excellent RR and a lot of upside. So the way this one will most likely play out, you'll probably see more upside into the Fed meeting on Wednesday. You're going to have a lot of nervous shorts. This has been one of the institution's favorite short trades recently with quantitative tightening. They figure get on the side of the Fed, but you're going to see a lot of, I believe, more short covering because who wants to get caught on the wrong side of a Fed pivot on Wednesday, and or anything that causes treasuries to rally. So there's that, and then you have the trend line, you have that 100.63 of resistance level, and then a break above that. Again, probably get a reaction in that area first, but then ultimately I think we'll break that and head on up to that 108 level. So there's still, and that'll be a total rally of about 17% in treasuries if that target's hit, which I believe it'll be, and still another 12% plus to go right there. And then of course I put probably as if not more of an emphasis on the actual yields, the 30-year yield right here, TYX. There's your trend line right there. Little wedge type overthrow. Wedge overshoot is when you have a bearish rising wedge and you pop up, and the same thing, you had the two candles up there and then followed by the reversal. And so a wedge overshoot, you have a brief overshoot, and when that happens, this is from my experience, this is something I labeled a wedge overshoot pattern. I notice you get these bearish rising wedges and you overshoot, and then it's usually a quick move back down and in without even quite often you don't even have a reaction once you get the overshoot like that. Once you come back into the wedge, you just go on to smash right through the downside with very little if any reaction. And so that would take us all the way down here to the more significant longer term uptrend line. Again, that would mean the long bond rallies while yields fall, and then support there. And then of course you want to also watch TNX. You want to I told you guys I've been spreading it around. I have the 5, 10, and 30-year treasury bond futures. TNX has now broken down today. A little whipsaw there. You can do a BOD, benefit of the doubt, if you want to pull it down like that, but even then we're starting to crack it. I like that because I have more reactions on that trend line. Negative divergence tells me that's the most likely scenario to break down, and you do have probably a minor reaction around here somewhere in there, or that previous high, but it should be a pretty swift reversal, I think, coming in treasury yields, which means pretty swift rally in bonds, and so far so good. And then FVX, that's your 5-year. And again, I mentioned yesterday that one broke down, continues to move lower, the 5-year yield. And the bonds itself, I know you don't trade yields, you trade the bonds. So that's IEF for the 10-year right there. TLT I already covered as the 30-year, 20 to 30 they say. This one they say 7 to 10, so they're targeting the 10-year bond. And then IEI is the 5-year. It says 3 to 7 because they're holding different maturities, but they're targeting that 5-year range. And there's your breakout candle, and there's upside. So this. There are no guarantees. Believe me, the Fed can do what the Fed can and will do what the Fed's going to do. But should this play out, then that would be a nice rally, and that would also be indicative of a Fed pivot. And when I say pivot, again, I have to be very careful with my words. I don't think they're going to cut rates. Nobody does. It's just they're going to raise less or talk about slowing the rate hikes down. or maybe even pausing for a little bit, waiting to see what happens. They've obviously, we're seeing the effects of the rising rates already. And anywho, this is again one of many things. Trade. I like to trade different things, diversified. But as far as swing and trend positions, this is one I like. And the thing about two treasuries is, the one thing is treasuries aren't going to zero. Any stock you buy, Apple, name any stock, can technically, theoretically go to zero. Treasury bonds can't and won't. Because the government will just print more money they'll do a technical devaluation is what countries do when they get in over their heads and they printed too much money and incurred too much debt. Then they just print their way out of it, and that's a technical default. In other words, bonds will be worth less and less as they issue more and more of them, but they're going to be around. And again, this is the U.S. If the U.S. Treasury bond yields continue to go up, as I said, it'll be financial Armageddon around the world. We can't finance our debt. U.S. is just one big Ponzi scheme. Just keep paying out money to everybody, getting in debt, more and more and more, and issuing treasury bonds to pay for it, and get all the obligations that we have on the hook, Social Security, Medicare, and all the other social programs that we have, and they've got to be paid for, and we can't finance it. Our debt cost is going to go spiraling if treasury yields continue to go up. We have to service that debt. That's how we finance it. Finance our operations and all our spending is via debt. So, there's going to come a point, and I think we've already hit that point where the Fed realizes, okay, we're talking too tough a talk. Yeah, we want to get inflation under control, but on the other side, we're going to collapse the financial system if Treasury bonds continue up at this rate. So that's what I've been talking about for a while. It's, not to say that, Fed could do something and you get a little spike down, but again, the downside, in my opinion, is very minimal. Relatively minimal, I should say, on treasury bond prices versus what the stock market can do if we have a real shock to the system, in addition to the cracks that we've already seen so far. Let me get to natural gas because it's bugging me that I'm usually a little more accurate when I report the gains and losses on a trade. Somebody pointed out it wasn't a 20% profit on NG. My apologies, it wasn't. It was north of a 10. But what I mentioned, and again, you have to read through on the original post. If I link something like this, you can see the underline. You can link it, and that'll bring you to the first post. Here, we'll do that. Let's just go back to that first post. So I made it very clear when I put the trade idea out there. Natural gas then was trading at 5.547, but I made it clear that I'm using the November contract that was last week on, what was that, Thursday, whatever the 20th was, because that was at that point in time, the current contract, it had by far the most volume. But I said, look, we're going to be rolling to the Decembers coming this week, and so volume is still higher in the Novembers. So soon I'll follow up with the revised price targets for the December, which I did. I did that actually day before yesterday, and I gave you the 60-minute chart. Now, with natural gas, with all futures, you have a differential in price between the various months contracts. Typically, the farther you go out, the more the futures are going to be on let's say the stock index is usually a higher price, but that can all change, especially with natural gas. You have all kinds of things like contango, backwardization, and all this, because natural gas, especially, is very volatile. Prices are so volatile because the way it's difficult to store, and so therefore that's why you have such big price swings, and you also have a big differential in the futures. So what I did, just to get these posts out to you, I looked at the entry price, forgetting that not realizing, of course, there was a big difference at this point in time between the Novembers and the December. So it was 540 something, and then this one 6 something, and so somebody brought that up that the prices were a lot different, and that's why, because again, I made it very clear yesterday here, the day before yesterday when I followed up with the December contract. So you have a different prices, and I also gave you revised targets then when I put that out yesterday. Here it was right here. That was the one I put out day before yesterday on the 24th, and gave you just 2 price targets. And we hit that first one, so take profits, or game a pullback, book profits, or raise your stops if you're going to hold out. And then somebody asked, what are the chances for T2? I'll zoom in for you. I said pretty good, in my opinion, but negative divergence and minor uptrend line break on this natural gas 10-minute chart are likely to be the catalyst for pullback to any or all of these support levels. This is that chart. So where I'm going, I highly encourage you, if you're in a trade or interested in just following it, subscribe to that thread on the front page post. What that means right here, when you go down, there it is, subscribe, you hit that, and you'll get new follow-up comments. So you would have seen this chart. And again, so that's what it looked like. Had a nice clean uptrend line, negative divergence here on the 10-minute chart, and I gave 3 targets for the pullback, and we hit them today. And so I gained that pullback, reversed back long this morning. The timing was good because had it happened in the middle of the night, I wouldn't have seen it. So where is it? NG right here. Nope, that's the November. NG, here's the December that we're trading. Here's that same pattern right here. And so that was the uptrend line. There was a negative divergence right there. And I gave you, well, that's kind of obscured by that T1 from the daily chart. The 1, 2, 3 pullback targets I gave were right here this morning, right there. We overshot it. That was a momentum fueled overshoot. You see that what happens? You get this. This is a selling climax, and I figured that'd be a momentum fueled overshoot, and it was right on that target. So that was where I covered the the pullback short and reverse long, and then we're right up back to, I added these levels yesterday, and that was where we went to that bounce target there. So I took profits, but I'm going to recycle back in. I think we're just going to consolidate and then move on up. At most a pullback to here, but again, I don't think we're going to. I think we'll consolidate here and punch on through, and then again we turn back to that 120-minute chart I gave you, and that's what the official targets are on for this trade. So there it is. You had a momentum fueled overshoot of the first target, but again, this is why I trade multiple time frames. If you look at the 10-minute chart, it's kind of like looking under a microscope, and then you can see what you can't see here on this 120-minute chart, meaning 2-hour candles. That was at 10-minute, and there was a pullback right to that second of three close by targets. And then if this plays out, because remember, the bigger picture was this steep bullish falling wedge. We had a trend line support on the daily that I showed on the post last week. So that's how that should play out, and then a reversal off that level. So that's the update on natural gas. And again, my apologies for over reporting based on calculating the entry price on the November contract, but then yesterday's, and I don't use the high when it was, I use where T1 was. That was what I was calculating, but again, it was the wrong math because there was a pretty big differential in price between the November and the December contracts. Okay, last but not least, let's talk risk-off assets. Just the other day, I posted as risk-off back on, meaning that forever and a day, for quite some time, for years now, Treasury bonds and stocks, the stock market had an inverse correlation. One would go up, the other go down. It worked well for asset allocation, the whole thing that financial advisors tell you to do, and in pension funds and the likes they live by, the old 60-40 rule, or whatever your asset allocation mix is. Typically you take the number 100 minus your age, and that's the amount you should have into equities. So if you're young, you're 20 years old, you should have 80% of your money in equities, 20% in the bonds. And the older you get, you're shifting money out of the stock market, which are risk on higher growth assets, and into the more stable treasury bonds. Because if you're 60 years old and you plan to retire at 65, you don't have the long-term time horizon. You can't ride out a bear market and take a 50% drop in your equity portion. That's how those asset allocation models work. And for many years, many decades, it worked well. And then something changed. We're back to an inflationary environment. And this thing happened back in the 70s too, when we had a hyperinflationary environment. The bonds go back to a positive correlation with the stock market. However, as I said, nothing lasts forever. And so far we are seeing or at least I suspect we can see a possible reversal back to where you see the risk on or risk off assets such as treasury bonds, gold, and even crypto. At one point, crypto was considered a risk off asset or an alternative to the stock market. But let me start out here first with the euro US dollar. That's my proxy for the dollar index. You can use the dollar index, USDOLR, same thing, breakdown sell signal. Highlighted here recently, this divergent high. Break of this trend line would give you a sell signal. We got it. We went down. We've now are at my first target, and that's that level right there, that horizontal support line. So maybe a reaction here, maybe not, and but I still favor at least a move down here, and then quite possibly more. This is a big divergent high, i.e. negative divergence. This little correction off the high is not commensurate with the scope of that divergence. That says likely more downside to come in the dollar going forward. And then my go-to proxy is the euro, because the euro is the biggest component of the dollar index at about 57.6% weighting. And look at that, just beautiful price action. You had that downtrend line, very, very well defined. What I mean by that, lots of clean, distinct reactions along the way, and then boom, pop, breakout. However, right into resistance, and also positive divergence at the low. And so this has been bullish. It's bullish so far. Treasury bonds, oddly enough, have been correlated more to the euro. As the euro has been falling, treasuries are falling, but lately, the correlation's intact. So we've seen the euro rally. This is also very bullish for gold, should be, and I think gold's even under reflecting right now what's going on in the euro and a drop in the dollar. Again, gold is inversely correlated to the dollar, means dollar up, gold down. And dollar down, gold up. And the euro, remember, is inverse to the dollar. So the euro and gold have a positive correlation. When the euro goes up, gold should go up, and vice versa. Okay, now 60-minute chart couldn't be playing out any more perfectly. Let me show you something. So the last 60-minute chart I gave you was right here, and that said next buy signal on euro, US dollar, and gold. If it breaks above the bullish 60-minute bullish falling wedge, meaning the wedge for gold, will come on a break above this symmetrical triangle pattern. That's right here. That was a beautiful pattern. And you won't see things like this on CNBC. Micro precision calls go up to 099565, have a reaction. That's what the arrow breaks denote. Then go up to 1.0340, have another reaction. Then go up to 1.0154. That was right here. All my charts are time and date stamped the 21st. So that was 5 days ago. And let's pull up the current chart and show you what happened. Here it is. These lines have not been moved. Breakout of the triangle pattern. Perfect back test. So if you missed the breakout, and again, you also had, I told you, a BOD, benefit of the doubt support, where I expected a reaction. So when you broke out, you hit that, and as expected, that sellers stepped in, sold there. But then the breakout was intact. You had a back test, so you could have bought the back test, and there was also support there as well. And then you went up. You hit my first target, that 0.099565, and this is what I define as a reaction. A reaction is one of two things. When you're coming up, and look at the move up. It's just straight up to that level in a perfect reaction. I define a reaction as a pullback and or a consolidation, and we just hugged that level. Traders bought it, hugged it, and it's more powerful in a rally when you have no pullback, just a little consolidation on the resistance level. And then look, you didn't kind of zigzag, you just exploded up to the next level. You had another reaction, a minor pullback, and now boom, you popped it. So now the way this works, and there are no guarantees, I can tell you it's not going to continue to play out so perfectly, but in a perfect world, and who knows, maybe it will, if you get a pullback to the 1.0340 level, great, that's objective, long entry. But now that we've taken it out, regardless of whether we get a pullback or not, it should open the door to my next target right there. But remember, there's a lot of buts in trading, and that is I use multiple time frames. I'm just going to add a trend line right here for my own sake before I move on. Remember, this is a 60-minute chart. So what you're not seeing right here is what I just showed you here on the daily, and that is the fact we're at pretty significant resistance. Therefore, it's going to be a little bit tougher slog going forward unless this level gets taken out. So if I'm trading only on this time frame, I said, well, maybe we'll get a pullback and back test this trend line. And here's another trend line we can add now off the lows, which I'll add right now. All right, so that's how this works. So, it's been a nice move. The Fed meeting's coming up, and that's going to have a lot of traders. You're not going to see an explosive move, I don't think, in the euro or the dollar until after the Fed. So I think the easy money's been made right now. If you're trading the euro, I would take profits. This is what I would do right now. Even though this is a nice breakout as an active trader. If you're a swing trader, hold it, and with a stop somewhat above this line. This is a constructive chart. I'll just be clear, not to be wishy-washy. I still think there's more upside. I've been maintaining that for quite a while, at least to this downtrend line right here. However, traders are likely to kind of go into a holding pattern because no one wants to, stack up and take a big bet in front of an FOMC announcement. If the Fed comes across as more hawkish than the market thinks they're going to be, then that means the dollar is going to go up and the euro is going to fall. And it could fall quite a bit. This whole rally could be sold into. But if the Fed pivots at all, even the slightest rhetoric, an implicit suggestion, they may slow things down a bit and take a wait and see approach, and then the markets smell a weaker dollar. Will instantly price that in, and the dollar should then pull back, and the euro should go on up. And again, you can see all the levels, resistance levels overhead. So that's it. So far, bottom line, it's played out very well, and this lift up again is and should be bullish for gold, and I think gold's not fully reflecting that in right now, but that also makes sense because you have the big FOMC meeting coming up. Remember, gold has this nice positive divergence, so the charts are telling me the same thing, whether I'm reading the tea leaves right or wrong. The charts are saying gold's poised to rally, the euro's poised to rally, the dollar's poised to fall. Don't guarantee it's going to happen, just like the stock market. Maybe those divergences get foiled, and the trend continues with gold moving lower. This is still massive resistance of about 158 for gold. It has to overtake to really open the door for a much bigger rally. So again, we've got a week to go now before the FOMC meeting, so I don't expect any major fireworks in gold. And the downside, and this is why that's why I do these videos. I was going to get some charts out to you this morning, and I figured which one to get, which one to post. There's just so much I'm seeing. And this has given me a little pause, and this is why I think gold's not rallying as hard as it should be based on the strength of the euro and the drop in the dollar recently. Is this 60-minute divergence? You know me and these divergent highs and lows, especially on my go-to 60-minute time frames. You have a lot of cross currents, but you can just look at them all here. This was a divergent high right here, right? Negative divergence, and you had a nice trend line break for a sell signal. You broke it, back tested, and then you dropped. And you kept dropping until you had this divergent low, right? And then you rallied. And you rallied right up to, you got it, till you had a divergent high. Negative divergence right there. And then you dropped. And then you set up a nice bullish falling wedge with positive divergence. And then you broke the wedge. And there was your buy signal. And then you rallied. There was maybe minor divergence. It was very small divergence there. But other than that, you ran into a big resistance level. You reversed, and then you set up this nice clean downtrend line with positive divergence. And we just broke out of this divergent low, and the move has been so far smaller, this move from the low to this recent high, smaller than what you would expect based on that divergence, and it was a double bottom low as well, which is a big thing right there. So now, with that being said, we're going into the Fed meeting next week, and gold has this negative divergence. Now, if this plays out the way I suspect it will, this divergence will probably get burned through. Now, we may get a little more downside. Here's your uptrend line. So far you're wedging right here with that divergence. So what gold needs to do, and I suspect it'll do it, is break above there and take out the divergence. And then it should open the door for a nice move up. But until then, you got to respect it. It is what it is. It's a negative divergence. So we're getting a little weakness in gold here. If it breaks that trend line, not the end of the world, but not great. What's really bad if it takes out these recent lows, that double bottom low, and this divergence does play out. Silver, almost the same thing there. Like I said, silver tends to move up and down with gold. It just moves up and down, usually more in percentage terms. But just like gold, you also have on the 60-minute time frame negative divergence right there. And remember, the euro US dollar, well, the US dollar, as I showed you earlier, the dollar index itself is at good support, my first downside target after the trend line break. And then on the flip side, the euro US dollar pair is at pretty significant resistance. So bottom line, don't expect gold and silver to do much going forward. If the trend continues, silver's been this is a 3-month chart, up down, and again, swing trade. This is what this site's all about. To me, investing, I don't know, people do it because people work and do other things in their life and don't immerse. You have to immerse yourself in this stuff to be successful at it. But you can extract a lot of money from the market or any security, natural gas, gold, silver, even in a sideways market or a bear market, if you're actively trading. And that's where it's at. So right now, the bottom line is, if you're an investor, trend trader, you can hold off and hope and expect these divergences to get burned out, but have your stops in place. Where would a stop make sense? Well, there's a nice uptrend line on silver. And again, it's everything I just talked about. It's not just the charts of silver, just a chart of gold. It's the chart of the US dollar. It's the chart of the euro. It's what the Fed does. All those things are going to play into this. So as of now, I would be a buyer on weakness in down to, but not below this level. Again, kind of contingent on what the dollar and the euro and gold are doing at the time as well. But for at least today and going into the Fed meeting, unless these divergences get burned through, meaning we start moving up and take them out, and the euro breaks above the resistance level I show you, and the dollar breaks support. And again, let me backpedal. Even if that happened, take it with a big grain of salt, because it's like buying Apple today when they report earnings tomorrow. So any breakout, now I've said this time and time over the years, any breakout that occurs on a bullish or a bearish chart pattern on a stock right before earnings, I disregard it because it's often going to be reversed. It's going to prove to be a whipsaw because there's that pre-earnings volatility, and then what they do at earnings can change everything. Just like right now, where I'm going with the gold, silver, and the US dollar, if they break out between now and next Wednesday, well, guess what? That can all be reversed depending on what the Fed does. So if you're a gambler, take it. Or if you're an active trader, take it and just, trade off the, 60-minute, 10, 15, 20-minute time frames, 30-minute charts, 5-minute charts. But then what I would do is lighten up before the Fed because once the announcement comes, everything moves so fast. The only way to successfully trade that is to have your orders already in place, your stop loss orders and your sell limit orders or buy limit orders, and let those orders fill in that post-Fed volatility. Otherwise, just sit, wait for it to be over, and then engage. Okay, that's it. Oh, crypto. Well, I gave you the charts of crypto yesterday. Look, as long as the stock market rallies, crypto's likely to rally. I give you GBTC. I give you ETHE. This is just a beautiful chart. I highlighted it back here. I liked it there. Told you we had divergences setting up, and we were at support. Gave you 3 targets on the 60-minute chart, and we really never violated. If you were going for T4 back then, I haven't updated in a while. We entered somewhere in here. We had our first and second targets right there and there. But from a risk-reward perspective, using a 3-to-1 or better RR, if you were targeting that, you never would have been stopped out. It just would have been a sideways slog. I kind of got away from trading crypto for a while personally, so I just didn't do any updates. But like I said, it looks good right here. But How do I say this? I have a very mild position in the cryptos long because of my suspicions about the rally in that analog that I used at 2008. We're going to have a better idea tomorrow once Apple and Amazon are out of the way. But like I said, so far, what we've heard coming out of Alphabet and Microsoft is not good for the stock market or the tech sector. And if Apple and or Amazon both give something similar, then we're probably going to take that next leg down in the bear market. And so far all year, just like the stock market, crypto has moved in almost lockstep, rallying with a positive correlation. And remember, we've been rallying in the stock market lately, so that could fizzle out too. As of now, the chart's constructive, the momentum's there, but again, I won't. I may throw this position away any day now, and I use the futures BRR and ETHUSDRR. That's the Ethereum futures and Bitcoin futures. But they will. I'll see what happens after Apple, Amazon, and then of course the Fed next week. Because it's going to either make or break this rally. I'm talking about the setup we have in the equity markets, those bullish divergences, and everything that's happened so far. So this is either going to be this, I suspect, within the next, after a week from now, we're either going to do that, or we're going to build on these gains, and maybe a little volatility in between, but as long as we hold those lows and then head on up there. And again, I'm fine flip-flopping in and out. I'll just actively trade for the next week or so, or sit back some days, do nothing, or trade something else. There's always something, whether it's lumber or cotton or natural gas or anything else. All right, I'm going to wrap it up here, and since I started the video, there's where we were. See, everyone's looking for the gap right here, trying to get a gap backfill, and I never understand those folks that have their sell limit order right at the gap when all eyes are going to see it, and so far that's where the sellers stepped in. So since the beginning of the video, we've dropped about 0.5%, and I think we have more to go. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.